Welcome to the Stock Health series. In this series we are going to look at certain parameters and get to the final health score of the stock requested by you in the comments section. Today's stock is Dmart, which was requested by one of our amazing subscriber. It has a market cap around 3 lakh crores and stock price around 4,800. Dmart has revenues from the retail model. Estimated growth rates for the retail segment is around 12%. Though we have high business growth of 12%, but still Avenue Supermart gets 8 out of possible 10 in business model score because of the lesser diversification. In case of liquidity, let's look at these three parameters. Debt to equity is long-term plus short-term borrowing divided by equity, which in this case comes 0 as there is negligible debt. Interest coverage is earnings before interest and taxes divided by the interest portion. In the case of Dmart, it is 54. It is great as it is above 1 here. Let's see current ratio. Current ratio is current asset divided by current liability. In this case, it is 2.88. So we have a liquidity score of perfect 5 out of 5. For activity score, let's look at the cash conversion cycle, which explains a lot about cash and product management simultaneously. In cash cycle, cash goes out to the supplier, who provides raw material to the company. Raw materials are processed to the final product, which sits on the company's inventory. The product is then passed on to the customer on credit or on an instant cash basis, which is then received back to the company. Ideal time to complete this cycle is -30 to 180 days. You will get to know about this in a moment. Cash conversion cycle is days of sales plus days of inventory minus days of payables. Days of sales is time required by customers to pay. Days of inventory is time taken by products sitting on inventory. And days of payables is time taken by company to pay to its suppliers. Days of sales is receivables by revenue multiplied by 365. Days of inventory is inventory divided by cost of goods sold multiplied by 365. And days of payables is payables by purchases multiplied by 365. Ideal values are mentioned on right side. After calculating this for Dmart we get 1, 36, and 7 respectively. Inventory's best figure depends on industry and product. So the cash conversion cycle for Dmart is 30 days. Hence we have an activity score of 8 out of 10, that's the best we have seen so far in the Stock Health series. For profitability score, we will be looking at NPM, ROCE and ROE to see the efficiency of the company to generate profits out of current available capital and assets. Net profit margin is final profit divided by revenue. In case of Dmart it is 4.56% this year. Return on capital employed is calculated by profit before interest and taxes divided by total assets minus short-term liability. Here it is 16.92%. Return on equity is profit minus minority interest divided by equity. So, it is 12.63% in this case. Considering the last 5-year data for all of the above ratios, Dmart gets a profitability score of 3 out of 5. In terms of governance, promoter holding and pledge percentage are very important. Here we have no problem as Dmart has promoter holding around 75% and there are no shares pledged. So in the case of governance, Dmart gets 9 out of possible 10. In statistics, a metric called standard deviation is used to figure out how stable or consistent the values are. Lower values of standard deviation symbolizes most stability. In this case we will be running standard deviation on last 5 years data of NPM and ROCE, which come out 0.34 and 2.24 respectively. So, Dmart gets a 4 out of 5 in stability. In miscellaneous score, we will be looking for other pros and cons of the company. In Dmart's case, there is no doubt that they have a low pricing structure which helps them secure their customer base. But on the other hand, delivery companies such as Blinkit, Swiggy Instamart and Zepto can lower their market share in near future. So they get a score of 5 out of possible 10. Revenue growth of Dmart in terms of compound annual growth rate for the last 3, 5 and 7 years is 24.5, 19 and 21.7 respectively. The estimated growth for revenue for the next 5 years is around 14%, which is amazingly high. So the growth score comes a perfect 15 out of 15. Price to sales is a good ratio to find cheaper stocks quickly. Generally, cheaper stocks have PS lower than 5. It's calculated as market cap divided by revenue. In our case, it is 5.25, which is not so cheaper. Proper market value is calculated by justified earnings multiplied by adjusted PE. In Dmart's case, justified earning is 2,707 crore, which is multiplied to the adjusted PE according to 14% growth, which is 43. So we get the proper value as 1,16,000 crores, which is quite lesser to its actual value. Which says the stock is overvalued by 167%. By estimating future value using CAGR, NPM, and PE, we get a forecasted value of 2,25,000, which shows negative returns in next 5 years. Hence we reach at a score of only 11 out of possible 30 in valuation. So after evaluating all the points, the final score for Dmart is 68 out of possible 100. You can pause the video for a summary. This video is only for educational purposes, not to be taken as investment advice. Do your due diligence before taking any investment decisions. Leave a comment about which stock would you love to see video on next.